Hello, everyone. For our financial model, we will be introducing mergers and acquisitions through providing an overview of a real-life merger and acquisition between two well-known companies in Best Buy and Future Shop. This specific acquisition occurred in the middle of 2001 in order to allow Best Buy to establish its Canadian franchise. We will also be going over an accretion and dilution model, which is another area of corporate finance that we will be introducing to you for the first time today. The management of Best Buy has asked you, a consultant for an external investment bank, to assist them in the decision-making process of whether to acquire Future Shop. To do this, management has requested that an accretion and dilution model for this acquisition be built. In addition, management will provide insight into Best Buy's books in order for you to perform an analysis of their share price to compare the pre-acquisition price to the projected post-acquisition price. The requirements of the model are as follows. You should have a dashboard that compiles pre-acquisition and post-acquisition financials for Best Buy. You are to perform a sensitivity analysis to determine what factors involved in the acquisition have the greatest effect on Best Buy's share price. You are to calculate the value of the acquisition, the maximum price per share Best Buy will be willing to pay, and the number of outstanding shares post-acquisition. Your model should be organized, well-formatted, and should fulfill the requirements of Best Buy's management. Next, I will be passing it off to Zaid to provide an overview of our model.
Thank you, Logan. Now let's see the start file of our model. First of all, we tried to find all the numbers we wanted for this analysis from credited online sources related to this specific merger and acquisition between Best Buy and Future Shop. But unfortunately, we had some shortage in the information for some data in that regard. So we used some of the actual numbers of the merger, and the other data we needed, we just took the average of other companies' mergers to fill in these specific numbers we needed. Now we're going to talk about our assumptions. We had three main assumptions we did for this model. First, the merger for this deal and model, we can say. First, the financing part, the tax rate, the synergy, write-ups, and the deal fees. For the financing part, we assumed that 20% of Best Buy paid 20% of the amount for Future Shop by stocks and 80% by cash, with the tax of 30%, tax rate being 30%. The synergy we said was approximately around $15 million, and this is also a number we searched online to have a reasonable number similar to that. And then for the write-ups, we added this column or these information because we saw that most acquisitions have some write-ups for their target. So we added that, and we included the additional depreciation caused by the write-ups. Also, we didn't forget, as I told you, the deal fees, which include legal, contract, and commission fees. Now we're gonna go to the main part. I'm gonna switch to complete solution. Before going into more details, I just wanna say that the red numbers in red are numbers that we took from the merger and acquisition, the same one. This the between Best Buy and Future Shop. But for the blue part, these are assumptions we had. Assumptions we believe that we couldn't find these numbers, as I told you, so we included them. That's why we have some red and some blue numbers. Okay. Now I'm gonna so for the acquirer Best Buy, the share price was $82.53 before the merger. Shares of 250 million shares were there for Best Buy, and earnings per share were $1.22. To make the deal, Best Buy issued around 5.6 million shares, which is the 20% we talked about earlier for the stocks. And also, it offered $17 per share for Future Shop when the price of the share was around $11.5. This gave $11.50, 11.50 cents. This gave an offer premium to Future Shop shareholders around 50%, as we can see here, 47.83% offer premium. That was that got the attention of Future Shop, and they wanted the deal to continue. When we multiply the number of shares and the offer price that Future Shop, that Best Buy did, we get around $580 million. That was the official offer price that Best Buy gave to Future Shop. Now, and the earnings per share, the projected earnings per share for before the merger for the target, which is Future Shop, was $1, around $1 for 2001. Now we're gonna go to the accrual and dilution analysis. Calculated the net income for each company alone by multiplying the outstanding shares with the forecasted earnings per share for 2001 for both cases, before and after tax situations. As you can see here, the formulas shown here, before and after tax. And then we're going to use the word pro forma. This word means that like everything is, like, say, revenues or costs or anything related to the numbers, excluding any unusual events, costs, revenues, etc. So everything usual, nothing surprising happening. This is what pro forma means. So if we combine both companies' projected pre-tax net income, we get around $482.7 million, as we can see here. Now we subtract the depreciation, the additional depreciation we had because of the write-ups we did. We also subtract the deal fees of $6 million, and we add the synergy of $15 million to arrive to the number of to the new pro forma of Best Buy after the merger, which is about $491.3 million. Note that there is no interest expense because we assumed that the financing of the deal was without any debt, which is like a huge assumption here, but we had to do it because we didn't know like the actual number. And now I'll pass it to Jaskrin.
Hey everybody. So starting from the pro forma net income, how we actually get this number is the number that I just calculated, the adjusted net income. So we need to still subtract the tax rate from that. So we're just going to take the pro forma pre-tax income, the adjusted amount, and then subtract that with the tax rate. And then we go to the pro forma shares outstanding. So we will take Best Buy's current outstanding shares and add them to the new shares that we are issuing for this acquisition. And we just add those two numbers up, and we get a total number of shares outstanding. And then we will calculate the pro forma earnings per share. And we can easily just do this by dividing the net income divided by the outstanding total shares. And here we get $1.35. And so now we got to look at Best Buy's earnings per shares standalone from before the acquisition. So this was $1.22. And we're just going to subtract these two numbers. And here we will see that the deal excreted 13 cents per share. So this is actually a positive number. So the deal was a success. And it's also a good idea to calculate the accretion and dilution as a percentage as well, since the number of shares a company issues can be pretty arbitrary. And here we just multiply the two numbers and just subtract 1. So we can get a percentage, and that is 64.79%. So after the accretion and dilution are done, we will perform a sensitivity analysis. So here we will just create a data table, which is pretty simple. And this analysis is typically done before a deal, since there are assumptions that could really factor in for the deal, and it could also offer a lot of insight towards what the company might want to get out of the deal as well. So over here, the two assumptions that we will be using are the offer price and the form of consideration, which we'll be using the percentage of cash. And the anchor for this data table will be, we will be using 13 cents, which is also the accretion per share. So here we will just be performing the data table real quick. As well, I'd like to add that this table also allows analysts to easily swap out certain assumptions and see how it can affect accretion and dilution. So here we just use the data table to get our numbers. We will just quickly format them over here. Okay, perfect. So these are our case by case analysis, and over here you can see that 80% of cash consideration and $17 offer price is our base case, which is highlighted in yellow here. And using this data, we could create a graph here, and this could just have a visual representation of what data and the assumptions are doing and how they can affect the deal. So over here, we can see that as we increase both of these assumptions, the deal starts to get worse. And the biggest assumption factor is the increased amount of cash issued. And we can see that the accretion starts to slightly drop off. And furthermore, the assumption for the increase in offer price also leads to a decrease in the amount of accretion Best Buy gets from the deal. And the best offer, I mean, the best possible scenario that we can get for the deal is going to be $10 for the offer price at a 20% consideration of cash, and the worst off offer is a $20 offer price with a 100% cash consideration. And thank you for tuning in and listening to us and our group, and I hope that you could learn something from this. Thank you.